welcome you with us here on Business Today. I'm Abha Bakaya. Here are the headlines tonight. Markets extend rally for fourth straight day. Sensex jumps 533 points. Nifty up 157 points to close above 18,200. Auto, metal, power and realty stocks gain. Tectonic Wednesday as top IT companies declare quarterly numbers. A mixed bag. TCS and Infosys beat estimates. Wipro revenue misses expectations. Industrial production grows by 1.4% in November. Manufacturing sector lags at just 0.9%. Big jump in consumer inflation as it jumps to 5.9% in December. LIC planning to file IPO papers in the last week of January, say agency reports. Government pushing for a valuation of 15 lakh crore rupees, making LIC India's second largest company after Reliance. Vodafone-Idea rallies 9% on management clarification that government is not interested in managing the affairs of the company. Markets extending gains for the fourth session now. Sensex ending 533 points or 0.8% higher at 61,150. Nifty settling up 150 odd points at 18,212. Metal, power, auto, oil and gas, realty stocks all gaining. In fact, those indices up 1 to 2%, while IT and pharma indices ending flat. In broader markets, mid-cap and small-cap indices ended up close to 1% higher. M&M, Bharti Airtel, IndusInd Bank, Reliance Industries, Hindalco, some of the top nifty gainers for you. On the other hand, Titan, TCS, Shree Cement, Britannia and Cipla were the laggards. It was a mega tech results day with three of the largest Indian IT companies announcing their October-December results. The country's largest IT company, TCS, has announced net profit of 9,769 crore rupees, up 1.5% on a quarterly basis. Revenues are up 4.3% at 48,885 crore rupees. TCS has announced a dip in margins by 1.6% on a year-on-year basis. The company has also announced a share buyback of 18,000 crore rupees at 4,500 rupees per share. Infosys has raised its revenue growth guidance for the year by 20%, even as its profit for the quarter rose 7.1%. The company's revenue rose nearly 8%. However, margins dropped by 10 bips in the quarter. Wipro disappointing analysts a little with a minuscule 1.3% growth in profits. Company revenues for the October to December period grew 3.4% on a quarterly basis, even as margins dipped by 20 bips.
The quarter also has been a standout quarter from our talent management perspective. Our attrition, though it is inching up, continues to be the best in class by far in the industry. And we have an LTM attrition of 15.3% this year. But despite that attrition, we were able to increase our total associate count by 87,725 on a year-on-year basis, both managing attrition as well as attracting the right talent to power our growth across the board.
We are increasing our annual revenue growth guidance, which was previously 16.5% to 17.5%. We're increasing it to 19.5% to 20% in constant currency terms. Our operating margin guidance remains 22% to 24%. We've increased our guidance, so there's a tremendous confidence in what we're seeing with our clients. We had large deals at 2.5 billion, 25 deals in the quarter. Our pipeline itself is very strong, and we remain comfortable. Of course, the guidance is for this financial year, which ends in March. But overall, the demand environment looks really strong. So we are comfortable as we look out beyond March as well. The demand outlook is good, the digital transformations are strong, and our work in cloud and digital remains very good. We're also very strong with our supply capabilities, and so we remain comfortable in delivering all of the work for our clients.
The Life Insurance Corporation of India is expected to file its draft red herring prospectus with SEBI for its mega IPO in the week of the general budget beginning the first day of February. A Finance Ministry official has confirmed that the DRHP preparation is underway and should be complete by month end. The forthcoming IPO is expected to be the largest ever in India and will put LIC in the league of India's biggest companies. Business Today TV's Karishma Sudani standing by with more details.
Well, right, the Life Insurance Corporation of India is looking to file the draft IPO prospectus in the budget week, which is going to be the end of this month. In fact, the government is currently awaiting final evaluation report. Top sources in Finance Ministry also tell us that the embedded value of September is currently being worked out. The government was in fact expecting to file the DRHP early this month, but since it's going to be one of the biggest IPOs, there are a lot of procedures and clearances that currently government is in the process of taking. Sources also tell us that it is unlikely that there will be a disinvestment target shortfall, which is of about 1.75 lakh crore announced in the last budget, because government is confident that they will be able to list LIC IPO before April 1, before the next fiscal year, and they're looking to sell about 5 to 10% stake into this. The budget is around the corner, and this comes as a big movement in terms of disinvestment and the government's announcement.
As the country battles the onset of a third COVID-19 wave in the new year, inflation has started to slowly crawl up the ladder. The consumer price inflation for December 2021 jumped to a 5-month high of 5.59%, with prices in urban areas rising the most. Rising input and commodity costs led to this surge. The maximum rise was in the prices of edible oils, followed by fuels and clothes. India's industrial growth, meanwhile, slowed to 1.4% in November from 3.2% the previous month. This is the slowest pace the industry has grown in 9 months. Vodafone-Idea rallied nearly 9% today after the company clarified that the government would not take over the operations of the telecom operator. The government of India is set to become the largest shareholder in Vodafone-Idea with a near 36% stake in the company. Vodafone-Idea said the move to convert interest dues to equity will help it to raise capital.
In this option of converting some of the DoT debt into equity, as you know, the company has a significant amount of debt. We have a stretched balance sheet. And I think anytime there's an option to convert that debt into equity is considered positive for the company. And especially considering the fact that most of the debt is to the government of India, it was clear to us that actually converting some of that debt into equity is a good option for the company to reduce its debt going forward. And hence the board has decided to make this conversion and avail of to the fullest extent the option that was offered by the government. It has been very clearly stated by the government that they do not want to run this company. They do not have the desire to take over the operations of this company. They want 3 private players in the market. They certainly do not want a duopoly or a monopoly. So I think the government has been very, very consistent in telling us that. They have made it also very clear that they want the promoters of this company to run this company going forward as well.
India's largest industrial conglomerate, the Tata Group, is rolling out the big guns by bagging the IPL title sponsorship for 2 years. It's also seeking to extend the sponsorship of IPL by 5 years more beyond 2024. The Salt Airlines Group, which annually spends a huge amount on advertising, is set to make a big brand splash at the IPL as it ramps up its retail play through an e-commerce super app. It also plans to revamp Air India, of course, and pilots, as well as many other initiatives from the several brands it has in its massive portfolio of companies.
Bombay House is really letting the purse strings loose. Mandarins at this iconic address, which houses the headquarters of a 154-year-old Tata Group. First, they splurged 18,000 crore rupees to pilot Air India back into its fold. Now, Tatas are spending 670 crore rupees over 2 years to get bragging rights at the IPL. What's more, BCCI is said to be in favor of its proposal of extending the IPL association with the House of Tatas. Sources have told Business Today that the Tatas have offered to sponsor the league for another 5 years. With the board considering giving the Tatas a right to match the highest offer in the next round of auctions in 2024. This would mean that the BCCI will face no loss of revenue in continuing with the Tatas as the sponsor of India's most watched sporting event. Tatas will also be permitted to activate 2 categories on an exclusive basis from the large stable of brands and change the same next year. For the BCCI, the new deal is a bit of a windfall. While the Tatas pay a rights fee of 301 crore rupees each for 2022 and 2023, in addition to an incremental fee of 68 crore rupees for additional matches, the cricket body would get 394 crore rupees from Revo. In addition, the Chinese mobile handset brand will also shell out a 6% assignment fee of 60 crore rupees in the next 2 years. As a result, BCCI gets nearly 13% extra than it would have received had Revo continued with the sponsorship. Bureau Report, Business Today Television.
You're with us here on Ask Udayan, the show where we answer all your stock-specific queries. Every Wednesday, simply send in your question to the number on your screen and we'll select a key few to be answered by our Global Business Editor, Udayan Mukherjee. Let's get started then, and Udayan, our first query today is coming in from Simla, and this one's to do with IPO allotments, and there's been a lot of furor, in fact, around that of late, with some investors very upset that they didn't get their opportunity. But let's listen in to this query coming in from Simla, Ritika Bakshi.
Hey Udayan, I'm Ritika from Shimla. I got one lot of PDM shares during the allotment and now stock trading is around 1200 level. Should I sell now or wait?
It's good to hear from Shimla first. Always nice to hear from the hills. But commiserations, because it's not worked out so far, this Paytm business. Almost at 2000 an entry and now already down 40% at 1200. So it's been a big knock on the stock price. But frankly, the more one sees of Paytm, the less convinced one feels about the path to profitability. The big problem with Paytm is not its payments business. It's this transition that it's trying to make from using its payments business customers to financial services, the NBFC kind of business. And that path is not very clear. So far, they've not made major inroads into the lending business. And they're facing some other problems on the regulatory front with the recent regulations which have come in from the RBI. They are not very supportive for Paytm's model going forward. Also, if you look at the number of people who have left the company, the top brass, I think they're facing some serious attrition at the top management level. And that's not usually a good sign for a fairly newly listed enterprise. So some trouble seems to be brewing at Paytm. I know the stock has corrected quite a bit, 40% already. But selling now would mean converting your notional losses into permanent losses. I would say, since you're sitting on significant losses already, you might as well wait it out and see if Paytm can get its act together over the next 1 year or so. But in the interim, there is every possibility, I must warn you, that the stock will go down into triple digits, which is less than 1,000 rupees, which would mean a 50% markdown on the price that you got your allotment. So it could get even scarier from here.
Okay, so that's some advice to take into account when you're looking at Paytm. Nehal Rupani also has a query. She's from Ahmedabad. Let's listen in.
I have 150 shares of Mahanagar Gas at around average price of 1,025, and I'm holding it for more than a year right now. I would like to know whether the long-term aspect of the MGL and outlook of a gas marketing company overall.
No, the problem is that MGL was touted as this major gas play many years back, and it has as you know, since you're an investor, that it is actually a consumer play in the gas business with large circles in Mumbai and surrounding areas of Mumbai where it supplies CNG too. But it's just not worked out that duo of MGL and IGL becoming great wealth creators. That has really not played out. So the stock, since, I mean, I don't think the stock has really created any wealth in the last 5 years. It was 1200 in 2017, and it continues to be grinding at around 900 in 2022. So in effect, it's not created any wealth at all. In fact, it's lost money for many shareholders. And right now there are some challenges with MGL, which is that the price of LNG is going up, which is squeezing its margins, and therefore profitability growth will be muted. I think high single digit maybe for MGL for the foreseeable future. So between MGL and IGL, I would still say that IGL is probably your better bet, but I don't think these stocks will become major wealth creators given the dynamics of the business. You're probably better off exiting when you get your price back and looking at other sectors.
Okay, Arvind Choksi from Burhanpur has a query on Greaves cotton, and we're getting in queries from all parts of the country, as we can see today. Arvind, go ahead.
Hello Jim, I am holding 10,000 shares of Greaves Cotton at the rate 150 rupees. What's your view on Greaves as an EV player?
No, I think Greaves Cotton is an interesting story, and you've gotten at a reasonably good price point. You're already making money. But stock actually doubled very quickly a few months ago, and then in the last 6 months, it's just consolidating nicely in this 130, 170 kind of a price band. But you're still in the money, and I think you'll probably continue to do quite well, because Greaves Cotton does many things. I mean, it's an engineering company which makes farm equipment and other equipment, but basically from a stock market perspective, it has become a classic electric vehicles play, because it makes these electric two-wheelers and three-wheelers, and that is where the management focus continues to be the thrust of its business. In fact, in December, they sold about 10,000 vehicles, electric vehicles, which has got the market very excited, and they're looking at doubling their capacity as well in Tamil Nadu. So I think as almost a pure EV play, if you want to look at it that way, I think Greaves Cotton makes a lot of sense because their initial forays have met with success. It's not terribly expensive for an EV company at maybe 28-30 P multiple on FY23 earnings. So if you're a long-term investor, I would say there's no harm in owning a proper EV company in your portfolio. Not a recommendation to buy, but since you already own it, I think it's probably a good one to hold on to.
It's interesting, Udayan, because a lot of investors are starting to track some of these much hyped themes. I mean, there is genuinely a lot of investment being put into the EV marketplace, but also ESG, for instance, is another theme that's much talked about. And investors are clearly starting to try and identify companies that are, actively pursuing the ESG agenda, for instance, or companies that could be, proxy plays on the EV theme, as we just discussed. Share with us whether you feel it's wise to go by these investments, just looking at themes as a fad vis-a-vis what the company is actually doing.
Sometimes these can be faddish, these investments, but sometimes they can be actually knocking on the doors of significant opportunity. So I think renewable energy and electric vehicles are probably not fads. I mean, they're probably very significant opportunities. We cannot see it yet because so much of our power in India is still thermal power, and we hardly see any electric vehicles on the road. But, in the next 3 or 4 years, which is the minimum horizon long-term investors should be looking at stocks from, I think these will become very powerful themes. And as I took pains to explain, that sometimes you can overpay for an opportunity. But in the case of Greaves Cotton, and again, this is not a recommendation to buy it, you're only buying it at a 28 P multiple. This is not the same as paying 2 lakh crores for a digital company which does not make profits yet. This is a highly profitable company. So when you are playing, I mean, look at how well the Adani Group stocks have done over the last year and couple of years. And some of them are focusing on renewable energy in a big way. So the market is sensing this opportunity and betting on companies which are already profitable and actually can become leaders in these emerging spaces such as renewable power or electric vehicles. So I would not dismiss them as complete fads and look at opportunities for profitable, well-run companies in the space.
Fantastic, and that's just it. Look for well-run companies in the space, and yes, these are perhaps some great opportunity areas that are also to be identified. Umesh Goyal has also got a query from New Delhi. We do have time to take one more, so let's listen in.
Hi Udayan, this is Umesh Goyal from New Delhi. I have 240 shares of Colgate Palmolive, which I bought at an average price of 1680 with a long-term view. Given that the shares are trading at 1450, is it time to get rid of these shares or should I invest more at the current levels to lower the average cost? Thank you.
Well, I wish I could say, Umesh, that you're onto a multi-bagger, but somehow I don't get that feeling that Colgate is the multi-bagger. You know, India has exciting stocks at this point in time. And while there are many things which people have always loved about stocks like Colgate, which is its multinational pedigree, its pristine balance sheet, no debt, its high return ratios of maybe 70–80%, these are all great things. But there is no growth. You know, the oral care business of Colgate is not growing. It's trying to supplement that with non-oral businesses and brands using the Palmolive brand. But I still think you're not going to get more than 4–5% volume growth annually from Colgate, which will translate into at best a 10% kind of earnings growth. Is it expensive for an MNC stock? Probably not. It trades at 32–33, much less than some of the loftier cousins like HUL. But there is no great growth, which is why if you see it over a period of time, last 6–7 years, Colgate has not been a wealth creator despite its pedigree. So I would say that this is not a suggestion to either sell it tomorrow or buy more, but I would say that if you're looking for that quality and class of stocks, which a lot of people do, which is MNC, high return ratio, no debt, then I think you're better off looking at something like P&G Hygiene, which I think has better growth metrics than Colgate. But I mean, to cut a long story short, I would say Colgate is not going to be a great growth stock going forward.
Udayan, do you feel consumption actually, you know, when I talk about staples, will actually see any kind of interest in 2022 or will it wane?
It's a tough one, Abha, because I think the lower end of the pyramid is still hurting. I know there's a lot of excitement about the stock market and what's happening in the cities, but if you just go down one notch, I think in the semi-urban areas or villages, people are hurting and they also contribute to the consumption basket. So I think you have to be very careful about what you're buying in consumption. I mean, if you're buying a paints company because there's a paints and real estate recovery in the cities, go ahead by all means. But if you're buying a small ticket rural consumption item, then I think you would need to be careful. So I would be careful of the names like Colgate, Britannia, even Dabur or Marico, probably even HUL. Never been a fond of ITC. But there are consumption themes which are not FMCG companies which might continue to come back strongly in 2022. But low-end staples, I would be a bit cautious about.
All right, that's about all the time we have on this edition of Ask Udayan. Udayan, thanks so much for taking out the time to answer those queries. And for those of you who'd still like to send in your questions, the numbers on your screen, do keep them coming and we'll take a select few every Wednesday.